All right, let's just get right into it. Why do most traders lose money? Well, it's usually for one simple reason. They're following the herd. They see a price shooting up, they jump in. They see it crashing down, they panic and sell. And you know what? That's the exact trap that smart money lays for them time and time again. See, the big players, they don't make a big show of what they're doing. They're not loud, they move quietly, in the background, setting up their positions while everyone else is distracted by the noise. So the real key here isn't to react to the big, flashy price moves. The key is learning how to see their silent footprints. You do it with a really cool tool called SMT Divergence. This is the thing that can show you when the market is basically lying to you. You know, when one asset is screaming go up, but another closely related one is quietly shaking its head no. So today, we're going to break down exactly how you can use this to stop being the one providing the liquidity and start trading with some real intent. We've all been there, right? That feeling of buying the absolute peak of a rally or selling in a panic right at the bottom just before it reverses? Yeah, that's the smart money trap in action. It's a cycle that runs on emotion, and it's precisely how the big institutions make their money, by taking the other side of the herd's predictable moves. Okay, so let's really get into it. What exactly is SMT divergence? I love this subtitle, Finding the Crack in the Mirror, because that's the perfect way to think about it. It's like you're looking at a reflection of the market and you spot a tiny flaw, a crack that tells you the picture you're seeing isn't quite right. Let's break down how this works. So at its core, SMT divergence is just a comparison tool. That's it. You take two things that usually move together, like Bitcoin and Ethereum, or the S&P 500 and the Nasdaq, and you just watch for the moment they stop dancing in sync. And this isn't just for stocks or crypto. This works everywhere. Forex, commodities, you name it. And this slide lays it out perfectly. So look on the left. That's your normal market, right? Asset A and Asset B are best friends, moving in harmony, making similar highs, similar lows. But now look at the right side. You see the divergence? Asset A pushes up to make a brand new high, but Asset B just can't quite get there. It fails. That little mismatch, that crack in the pattern, that is the footprint. That's your signal that smart money might be quietly betting against the trend. Okay, so now let's talk about what this actually looks like on a chart. Here's an analogy for you. Think of the S&P, the Dow, and the Nasdaq as three runners in a race. 99% of the time, they're running together, side by side. But SMT is what happens when one of them starts to lag behind or stumble, even while the others are still sprinting ahead.
First up, let's talk about bullish SMT. This is your tool for finding hidden strength when, on the surface, the market looks really weak. It's like a secret heads-up that says, hey, even though this one asset is tanking, the overall selling pressure is actually fading out. A reversal could be right around the corner.
So here's the play-by-play. The market's trending down, right? Everyone's freaking out as Asset A makes a new lower low. It drops below its previous bottom. But here's the key. You look over at its buddy, Asset B, and Asset B refuses to go down that far. It actually forms a higher low. And that's the tell. That refusal to follow through to the downside is a massive sign of underlying strength. It's a clue that smart money is probably down there quietly buying up all the shares from the panic seller. Now, let's flip it completely. Bearish SMT is the exact opposite. This is your warning flare that tells you a super strong-looking rally might be totally fake. It helps you see when all that upward momentum is about to run out of steam, even while everyone else is still jumping on board.
So picture this. The trend is up, and Asset A is on a tear, making a new higher high. It pushes right past its old peak. Awesome, right? But at the same time, Asset B pushes up, and then it stalls out. It creates a lower high. It's already starting to roll over. That divergence tells you that the rally is an illusion. It's a huge warning sign that smart money is quietly getting ready to push this thing down.
Okay, so spotting the basic signal is great, but if you really want to trade with confidence, you need confirmation. So let's level up. We're going to add another powerful concept into the mix to create some truly high-probability trading setups. And that concept is the fair value gap, or FVG for short. Ever see price move so fast in one direction that it leaves a literal gap or a void between the candles? That's an FVG. You can think of it as the market leaving behind an IOU, saying, whoops, I moved a little too quickly there. I probably need to come back and revisit that spot later. And these gaps really do act like magnets for price. And this is where the magic happens. Here's how you put it all together. First, you figure out the main trend on a higher time frame. Let's say it's bearish. Second, you find a fair value gap that was left behind during a big move down.
Third, you just wait. You patiently wait for the price to get pulled back up into that FEG magnet zone. Then, and this is the most important part, while price is inside that zone, you zoom into a lower time frame and you look for that bearish SMT divergence we just talked about. When you get that signal inside the FEG, well, that's step 5. Your confidence in the trade just goes through the roof. You're not just trading one signal anymore, you're trading a powerful combination of market structure and smart money footprint.
So look, the big takeaway here is that SMT isn't some crystal ball. It's not about guessing. It's about completely changing the way you look at the market. You're shifting from just chasing price around to actually mapping out where the money, where the liquidity is likely to go next. So, to wrap it all up, your new edge really comes from this shift in perspective. You stop listening to all the noise and you start looking for the quiet footprints. You compare those correlated assets to find that crack in the mirror. Then you take it a step further and combine it with things like fair value gaps to build really solid, high-conviction trades. You start trading with real intention because you actually understand what's going on underneath the surface.
So I'll just leave you with this question. The market has its own rhythm, but most people are way too busy chasing the noise to ever hear it. Smart money, they hear the rhythm first. So if you start using a tool like SMT to filter out some of that noise, what do you think the market's real rhythm will start to tell you?